Perfect. So officially, good evening, guys. Sort of day three. What we will do is, any questions so far? Quickly on whatever we have discussed last few days on exchanges. So I'll just do a quick recap. So these are like generally the things that are spread across equity, currency, and interest rate, right? We spoke about forward futures, bid ask. The same thing. What is the contract size? What is the tick size? What is the expiry? How a contract behaves? Who are the market participants there? And then we discussed about calendar spread. With regards to the currency, we discussed about base currency quotation. And always please remember, unfortunately, you have to remember this. The quantity size of the currency. We will talk about interest rates. The quantity size as well. So in terms of the contract size for the equities, it varies, right? That's what I have shown you as well. For the Nifty, it varies. Not Nifty Bank Nifty, it's a standardized one. But for stock futures, it actually varies. But for currency derivatives, it is actually 1,000. The quantity. Whenever we do the numericals, you have to remember that. And then for the interest rate derivatives, which we will study today, is 2,000. Okay. Yeah. On that note, let's quickly move on to this one concept that I wanted to touch base upon. Because there will be 100% one question for sure. One or two questions on this concept, which is in the currency rate derivatives itself, right? So this is something called as an interest rate parity. Okay, so what does it mean? So primarily, imagine I'll also might be a little bit digress and talk about something about the economy that has happened over the last couple of years as well, right? So for example, if you see here, the banks in the India are paying. Is my voice okay?
Yes, sir. Voice is loud and
Yeah.
clear.
Sorry.
Your voice
Clear,
is loud.
clear.
Okay, perfect. Yeah. So the banks, say for example, the interest rate of the banks, Indian banks is say 7%, right? And then say the US banks are paying you 5%. Okay. So if you feel that, right, what, all the US guys or the NRS can feel, well, you know what, I'm not getting any money in the United States, and let me pull all the money out, from the United States and put it in the Indian bank, account, because it is actually giving me 7%. But in the realistic sense, does it happen? It doesn't, right? The reason being why it doesn't happen, because there is something called as currency appreciation depreciation that keeps happening, right? So let's actually go through one example. We will go through this example, and then I will simplify the formula for you at the end of the day, because we have to remember this formula. Unfortunately, there are certain numerical formulas you have to remember for the exam. Okay, can't help. So this is one of them, which is very important. Okay, but let's understand the concept here, right? So what am I doing here? So say for example, interest rate is 7% in the Indian bank account, and now I have 83 rupees. So for example, I'm just taking only 6 months, right? Imagine there is a uniform interest rate. What is going to happen? My money will go, in 6 months, my money will grow to 85.90. That's what it is, right? It's as simple as that. 83 times 3.5% is the interest that I'm receiving. My money will grow to 85.905. Okay. Whereas, now imagine, now I have converted that $83 into 83 rupees into $1, at the start. And now, again, US is paying me 5%, right? That's what we discussed. Now, for 6 months, what is the interest rate? The 6 months, the interest rate will be 2.5%. Okay. So, what will my dollar become? My dollar will become, 1.02. Okay. Here, my rupee has become 85.905. My dollar has become 1.02. Okay. Now, this is what it is, right? So, let's get into the numericals. So how do we equate this, right? Can we say that 85.905 is equal to 1.025? Let's go back to a little bit of a math, that we studied in our schools, long ago, right? So we have to equate this, in terms of, right, is it like which one is worth, which one is not worth, and what is the association, between these two numbers here. Okay. For that, what we will do is, we will actually do 84.905 equals to here. If you see, guys, please put yourself on mute. Okay. 85.905 equals to whatever the money I have made in dollars, 1.025 into the future exchange rate. Okay. Remember this one. Okay. So, 85.905 divided by 1.025. Guys, please mute yourself. Okay. Future exchange rate will become 83.8097. Okay. Don't get confused. Now let's actually switch to the formula here. Primarily, what is happening here is there is an interest rate difference between my current domestic currency and the foreign currency. Okay. How do I bring the parity between those, is what the question is all about. Okay. So for that, what I will be doing is, the formula, generally becomes, 83 is the, starting point that I have started with, right? Which is my 83 rupees times, this is 1 plus 7%. 7% is my, what I mean to say, the domestic currency, divided by into 0.5 is because we have taken 6 months only. Divided by 1 plus 5%, which is my foreign currency, for again 6 months, that will give me this 83.8097. Either you can do the math here like this, primarily this I have shown you to show how the money has grown for me, right? 85.905 and 1.025, but I need to bring a parity between that. My parity is this, right? 85.905 equals to 1.025 into future exchange rate. So rather than that, what I will do is, here 83 times 1 plus the domestic interest rate divided by 1 plus the foreign interest rate. Okay, so that's the formula. Don't worry, when I do the questions, we will do this question today so that you will be able to understand. Okay, so this is called, what we are trying to do is, we don't want the currencies to be far away. We are trying to bring the parity, between those currencies. Okay, so this is one of the very favorite question, and it's a very simple formula. Once we go through 1 to 2 numericals, you will be able to understand. Okay, I'll digress a little bit and just do 3 seconds of 30 seconds. What happened was, especially in the interest rates, generally what happens is, people actually do arbitrages. Okay, not relevant to the exam, etc. and all, right? At one point of time, now the Japan has increased its interest rates, but at one point of time, the Japanese interest rates were almost near zero or negative, right? And if you see, you've been already in the market for so long, you're all veterans here, right? So what most of the people, in US used to do is, the hedge funds and all the institutions, they used to borrow from Japan, at zero or negative interest rate, bring it back, bring it back, and then they actually used to invest in T-bills, in the US market, because T-bills used to give them 2.5, 3%, 3.5%, and then make that difference as money. That was one of the interesting mechanism where lot of hedge funds played, but unfortunately that music is over now. The music is no longer available. Okay. Any questions on this quickly? On the interest rate parity. There is a foreign exchange and there is a foreign currency and domestic currency, and we are trying to bring it together.
Kiran, just it is my expectation. It is not that one. I have not attended anything. I mean, attempted also. See, normally, suppose in the currency pairs, what will be happening? Suppose we are doing the USD INR, means USD is the base currency and the quoted currency is the Indian rupees, right? Suppose if it is going to be give the same interest rate calculation in respect to that, JPY to the UK Britain like that, actually Great Britain dollar like that. So if it is going to be given like that, we have to go through two calculations. One is that JPY to INR and as well as the GBD to INR. So those two compare and we can able to give the answer is the right way of approach, or otherwise any other formulas that you are going to be derived, or
Okay,
this
okay,
kind of
no,
questions are not asked at all.
hold on. This is again too much complication. This is more of a macroeconomics exam question that you are talking about. When you see, NISM wants to keep our lives easy as well, right? They don't want to complicate. To be frank, I like NISM to that extent. When you are
Yeah,
talking when you are talking about USD JPY, it's not that you have to convert from USD to INR to JPY. No, nothing like that. We will do one simple question, 2 to 3 questions. Let me go through interest rate derivatives real quick, and then we will actually do some questions. Then you will be able to understand. When, especially in this exam, they will be asking only about one currency pair, and you will be given the interest rates of the both the foreign currency and the whatever two currencies there, and it need not be INR there. Even if you take USD JPY, they will give the USD currency interest rate and JPY interest rate. You just need to calculate, and it is very simple. Okay, we'll go through the numericals and then understand.
Yeah. Here in the
Nothing
previous
like
question,
complication.
in the previous question also, you said that future incremental interest rate, how it is like that, we have calculated and we have given that one. 83.8097 is what is the future incremental that it is given, right? Okay.
Mhm.
Instead of that, there is some other tricky question was there. Suppose if the dollar rate is going to be increased, or the 83 to 83.5 like that. So what is the incremental rate? That kind of questions can be asked, or otherwise it is not going to be asked like that.
Sir, I will cover all the questions. I think let's not, let's go through step by step. There are little tricky questions in currency. I will cover all that when we study options, in
Okay.
the currency
Please,
module.
please go ahead. Please go ahead. Please go ahead. Yeah.
Yeah. Thanks. Okay. Let's quickly move on to interest rate derivatives, and I just want to quickly touch upon this, and then the goal today here is to do as many questions as possible, because I wanted to give you the flavor of what the exam is. This is around the theme 3 that we are studying. We have studied equity derivatives and we have studied currency derivatives, chapter 3, and this is interest rate derivatives, chapter 3, right? Okay. Let me quickly revise, right? In the equity derivatives, what are the futures against? The futures are against index, the futures are against the respective stock positions, right? Similarly, in currency, what has happened? The futures are against the respective pairs, the base pair vis-a-vis the quotation pair, right? So now what is exchange traded interest rate futures? This is more of to do with the debt market. This is more of a fixed income market. Okay, I'll actually show you, and then we can study this here. So primarily, the exam NISM is much more interested on 3 fixed income products at this point of time, or you could call like 3 instruments. Okay, especially for this exam. So similar to how the currency futures do happen. Okay, let me take a quick example. I'm sure a lot of you have distributed fixed income products, debt products, etc. and all. If you might have seen from the last 1 year, fixed income hasn't generated any return for us, to be frank, right? What exactly has happened when the RBI started decreasing the interest rates? Ideally the bond should go up, right? So that's ideally how the bonds are supposed to behave. Rather, what happened was, the G6 actually 10-year G6 corrected from somewhere around 7.4 to 6.2. Okay, because of varied reasons, right? Because demand, supply, we will not get into those details. That is more again once we pass the SIF exam, we will study those. When we are talking to the investors. Okay, now here the focus is more on that, right? Now hybrid long shorts, the SIF category is completely, most of the stuff is built on interest rate derivatives. Okay, they use actually G6 91-day T-bills, and they use corporate bonds, they use bunch of stuff here. Okay, now especially from the exam perspective, so sorry, let me go back to the quick example there. Now, in the futures, how do you make money? So, for example, if I'm actually trading the 10-year G6, right? So if I anticipate, like, the G6 instead of going up, it will come down, when the interest rates were, going down, what I will do is, I will blindly short, right? I will actually short the futures of the 10-year G6 and I will make money, which is what, the hybrid long shorts are trying to do. Either go long or either go short, okay? Now the G-Sec has come down to 6.2, and now the paper has sort of stabilized somewhere around 6.8. Okay, so at 6.2, what I will do, I will actually again take a long position, right? I will take again a long position in the future contract that hey, this G-Sec is supposed to go up, etc. and all from 6.2 to 6.2. Okay, so primarily, like how the in the first day how we have seen Reliance, and the second day yesterday we have seen currency, how those futures are traded. So the G6 91 day T-bills and overnight MIBORs, these are the three main instruments that exam is focused on. They wanted us to understand how these are traded, what are the lot sizes, what are the tick sizes, etc. That is what the whole interest rate derivatives as a exam which is part of this exam is all about. Okay, clear everyone? Any questions quickly? Okay, just to setting the ground there, right? Now, here what we have to do is, we have to learn a couple of things here. And now please look into the slide. I hope this is visible. People have requested for this to be bold and all. So, let me quickly let's do this here. Okay. I'll quickly come through. See, the reason why we are studying all these three chapters together is, like, as I said, there is a lot of overlap between all the three books, right? I'll quickly glance through futures contract, the same, the Goldsmith example that we have taken on the day one, interest rate futures, the possible underlines, please note that here, GOI 91 day, overnight MIBOR and corporate bond. Okay. So these are the four instruments, that are much more relevant for this particular exam. But of course, there are multiple other instruments in the real world, the fund managers actually do trade upon. But like these are the four, underlines, that we will, try to study, attempt to learn. Okay. So quickly, this is again trade daily before expiry, settlement, open interest. We studied all this stuff. Again, long, there is unlimited potential, for you to make money in the long. There is unlimited potential for you to make money in the short and the futures. Okay. Now here, I want you to focus on this slide, for a moment here, right? So what did we talk about in the currency derivatives portion? Please, look into the lot or the notional here. Okay. What is the lot size in currency? We discussed the lot size in the currency is 1000. And what is the tick size there? Anyone? You studied yesterday?
25 paise.
0.0025.
0.0025. It's the same thing here as well, right? Okay. So the lot size, in the GOI bond is 2000. Please, if take a screenshot anyway, I will upload this. This is one thing you have to remember. Unfortunately. So 91 day T-bill, again 2000 units is the quantity. Okay, because sometimes what they ask is, they will ask you the contract value. They will just give you, hey, I'm buying 10 lots and I'm buying at this price. What is the contract value for me for my 91 day T-bill or GOI? Okay, so those are the questions that you generally get. So there you have to multiply with 2000. Please note that, right? If you don't multiply with 2000, like you will end up in the wrong answer. So contract
For
value
only
is
for only 90 days this one, or otherwise it is for all everything 2000.
what, everything 2000.
Normally we are going to be check that lot size is 1000. So 2000 is going to be considered for what actually?
That's what I'm telling, sir. Government bonds, the quantity size is 2000. 91 day table, the quantity size is 2000.
Okay. Thank you. Yeah.
Yeah. Yeah, GOA, the lot size, is 2000. On the day one, if you remember, we have seen Reliance, the lot size is 500. In the GOA, the lot size is 2000. 91-day T-bill, lot size is 2000. Overnight MIBOR, we will study that in a bit. Okay. Now, the most important part, especially from this chapter perspective, the typical bid ask, market, market, MTM settlements, etc., and all that. Those are all very common, right? The most important part is we have to understand the calculations of this a little bit. So what I will do is 91-day T-bill and overnight MIBOR are little tricky. First let's cover the government bond, right? So primarily, okay. Here, for example, there is this. If you generally what happens is, you will get this question of, what is the single GOA bond, right? For example, if I am buying 5 lots, if you see here, right, I am buying 5 lots at 101 rupees. You can do the math at your end. If I am buying 5 lots at 101 rupees, what is the contract value? So that's a typical question, that you will get. Okay. So let's do the quick math here, so that you are comfortable. 5 times 101 times, what did we say? We have to do, we have to multiply with 2000, which is very, very important, right? Because, what is the, sorry, yeah, we mentioned, the lot size is 2000 there, right? So you have to multiply with 2000 to get this, okay? Government bond is very, straightforward. Okay, they will give you the lot size, they will give you the price. What you need to do is, just multiply the lot size with the price times 2000. It's very simple, as straight, very, very, quite straightforward. Okay. Now 91-day T-bill is little tricky. Okay. So how many of you know the concept of T-bill? To start with, might be there are a lot of experts here. Might be help me out with the T-bill now. The calculation here is little tricky, but we will go through the process first. Okay. How many of you know T-bills? Okay. Perfect. Let's go through that, right? So first of all, what is a T-bill, right? Uh, T-bills, the treasury bills, so let me take this quick example here, right? So for example, like your friend says, give me say 95 rupees today. In 3 months, I will give you back 100 rupees. Okay. So why will you actually, sort of do that? Because instead of giving 100 rupees, you are actually giving only 95 rupees and your friend is giving that 5 rupees. Okay. You're ideally making that the profit, from your friend for that particular period of time. Okay. So T-bills work exactly like that. Okay. T-bills, have a concept called discount. Okay. So let's go through this example and then we'll expand that to T-bill and we'll come to the formula. Okay. Because the formula is also very important. Okay. So simple thing, right? You hand over 96.25 today, you receive 100 in 91 days. How are T-bills calculated? T91, right? In the 91 days is when they generally, expire and they will pay you back. Okay. So what is your profit here? Your profit is 3.75. Okay. Now here is the interesting part that I want you guys to focus upon. Okay. Now, is the 3.75, I am going to make, is it for the full year? No, right? 3.75 is not for full year, but it is, for the quarter, only for the 90 days. Okay. So what we will, generally, let me show you this part. Right? Yeah, what we will generally do is, so we will divide this 3.75 divided by 1/4, which is because it is just only 90 days. And we will, arrive at something called as the discount. Okay. Don't get worried about that. It's little complicated. I will try to make it little more easy. Let's go through this one more thing here, right? So generally what happens is, especially for this exam, they will give you what is the quote. Quote is what, right? What is the amount that you're paying? 95 rupees is the amount that you're paying. So what did I say? 100 rupees is what you are going to get. So that 100 minus 95 is the discount rate that you are, giving. That is what, right? You are actually getting at a discount. You have to pay 100 rupees, but instead of that, you are actually paying only 95 rupees, right? For the investment purpose. So what is the discount rate? You are actually getting a discount rate of 5%, right? Until then, clear. Now, here what we will do is, as I mentioned here, 91 days is not full year, right? It's 1 quarter only. So what we will do is that 5% discount, we will divide it by, 91 by 365. You're getting it? So 5% times 91 divided by 365. Okay. We will arrive at the number of 1.25%. Clear, everyone? Okay. So ideally, what the yearly discount, what we are doing is, what am I going to get for quarterly is where I am actually, arriving at by dividing 91 by 365 times the discount that I got, 5%. Okay. Now here what we will do is, we will apply that discount actually to, so in this case, generally what happens is, the 100 rupees is the face value. What is the discount I got? Discount I got is 1.25. So 100 minus 1.25 is 98.7. Okay, that is my actual value. Okay, is it super confusing? Let's actually get to the formula here. Is it super confusing?
Kiran, I actually have a question.
Yeah, go ahead.
Yeah,
No, only related to the exam, please. Don't complicate.
Yeah. It's just a bad question. We are getting say 5%. Okay, as per just the example as you showed to us.
Mm-hmm.
Okay, but we are getting that in 3 months.
Mm-hmm.
So I'm getting 5 rupees for 3 months.
You're not getting 5 rupees for 3 months. You're getting 5 divided 5 into 1/4 in 3 months.
Okay, maybe there is some lack of understanding at my end, probably.
No, that is exactly what I'm saying, right? See, that 5% is on an annual basis, but that 5%, divided by 1/4 is where, you will be getting, for 1 quarter. Got it? Okay, don't worry, guys. I think let's focus on the exam part. So the here, what you have to do is, let me simplify this a little bit here. So for example, let me go back here. If they have given you, so let's do this quick math here, right? I am buying 10 lots at the quote of 95 is what they will generally give you. Okay. They will ask you to calculate what is the contract value. Okay. So the first thing what we have to do is identify, say 95, right? So first of all, 100 minus 95, what is this discount? 5 is the discount for me. You can either, divide 5 into 0.25. Sorry, let me do the math here. Right? 1.25 times, what will you do? 1.25 times, what is the lot size? 2000?
2000.
Yeah. Times, how much is this one? Sorry. Into how many lots? 10 lots, right? Okay, let me actually go to my PDF itself. I will repeat this might be again in tomorrow's class as well. Just a second. Okay, what the simple formula here is, so remember this formula. So primarily what we are trying to do here is, let me open it here. 2000 is the the contract size that we have discussed just now for the government of India and as well as the Treasury bills. Here what I'm doing is, this is my yield, replace this with yield. Okay, so for example, if he has given you 100, right, 100, sorry, if he has given you 85, right, 100 minus 85 is how much? 15, right? Here what comes here is, the 15 will come here. Got it, guys? Let's quickly do a couple of math here. This is for 95, right? Let's do for 90 and let's do for 85, for the same thing here. So what happens is, what is the discount here? The discount here is 5. The discount here is 10. The discount here is 50. Everyone with me? 100 minus whatever is the number. Because instead of paying 100 rupees, I'm paying 95. Instead of paying 100, I'm paying 90. Instead of paying 100, I'm paying 85. That is the discount. Okay, that is the discount value here. Okay, the formula here is 2000 is my quantity size times what I will do is 100 minus. Why am I doing 0.25? 0.25 is 1/4, right? It's 1/4. So 0.25 times 5. In this instance, it is 5 times. In case if I'm buying like 10 lots, that is my lot size here. Okay, that is a value that you are going to derive. Similarly, here what is going to happen is 2000 times 100 minus 0.25, because why? Per quarter times 10. Why? My discount is 10 times 10. Okay, that is going to my contract value here. Everyone following? 100 minus 0.25 again, because per quarter, again times here what is this? 15, that is the discount that I am actually getting, times 10, which is my 10 lots here. Okay, those are your answers. Clear everyone on this? Any questions? It's little tricky, don't worry, but just remember this, right? 2000 is my contract size. What I'm doing is, I'm first of all identifying my discount, 100 minus whatever is the amount that has been given.
So how the 0.25 is going to become?
That's what I told you, right? We 0.25 is 1/4, right? The discount divided by, see if it is the 5, that is for the year for me, divided by 1/4, because it's per quarter. So that is like, 0.25 has come there.
Okay, it is not related to the anything to lot size or the yield. It is going to be given like that, right?
No. This is what I've shown you right here. 91 days is not a full year, right? So what we are going to do is, this is the discount that I'm paying, or I'm getting. I'm going to reduce this discount into, for the quarter.
Yes, correct. Yes.
Yeah. Okay. Cool.
Kiran, in simple terms, if I understand, it is like if we want to get like 20 lakhs in 3 months, right? So initially now the contract value will be 1,98,000 whatsoever it is, right? 1,97,000.
Very good. Bingo. That's it. You got it, sir.
Yeah.
Perfect. I know super awesome explanation. I think you did a good explanation than me. Yeah. So primarily what you are doing is, you are actually paying, see, 19,75,000, for a 20 lakh value, right? So that is like, the, because it's a future contract value, right? In the future, I'm going to get 20 lakhs. Instead of paying 20 lakhs, I'm actually paying 19,75,000. Bingo. That's a perfect one. Okay. Okay, quickly, I wanted to
last example, you said 85 rupees you're paying. So if you take, you're getting 15 rupees discount. 15 rupees divided by 4, it will come to
0.375, but you return 0.25. Is my calculation is wrong, or how to understand this?
No. 15 divided by, no, that's what I have standardized the 0.25, no?
But it's not coming. It's 0.375 is coming there. 100.
Sir, 15 divided by 4 is how much, sir? Yeah, 3.75, no?
Yeah, but here 0.25 written, right? The last example.
Yeah, sir, like, 1/4 is where we are removing 0.4, right? So 15, okay, let's do the quick math here. I think I confused a little bit here. Point times 15. How much it is? 3.75, no?
Yeah.
15 is my discount, sir, right? For a year, right? What is my discount on the quarter? 3.75, no? That's what. Yeah, got it.
0.25 is irrespective of you're taking 0.25 as a base, or
0.25 is the base, because this is the quarter, because I'm more interested on, because T-bills expire in 91 days in one quarter, no? So that's why the 0.25 has come into the picture. Got it?
Kiran,
you're taking the time value there.
Sir, you mean to say that the value is divided in one, it is in quarters. So we have 4 quarters, we have taken only 1 quarter for this. Every time we have to change it to 1 quarter. Suppose if the TI bills is more than 6 months, then we have to double it.
Don't worry about that. The T-bills, they generally, your answer is correct. If it is 182 days, etc., but the exam will focus mostly on T91. Yeah.
Oh, right.
Yeah, Ashish, go ahead quickly.
Yeah, Kiran, in the starting we said that if we pay 95 rupees and we get 100 rupees, you are talking about the after 91 days, right? So if it is after 91 days, so it will won't be the multiply by this. It will be multiplied by 4 then. Correct me if I'm wrong. Or it is
no.
It is for 1 year.
It is 1 year. What we are trying to do is we are actually trying to divide, for the quarter primarily, right? People think like, it is for the quarter. Oh, you know what? I'm buying only T91. It is, thing, but it is on the quarterly basis.
So we are calculating 95 to 100 or 90 to 100 is for means annually, but later on we are converting into quarterly for the interest purpose, right?
That's correct. Yes.
Thank you.
Yeah. Okay. Quickly, I think it's almost 8:40. Sorry, this took a lot of time today. Let's quickly go through a couple of questions, right? I want you to quickly, fatafat, right? Keep answering this. We'll keep a track of that in the. Sorry, we'll keep a track of that in the chat. Might be. Is this good or I unfortunately can't see the chat. Let me see from the chat here. Okay. Perfect. Okay. See, the questions are completely. You can hold me accountable. But the questions will be completely around whatever we have studied on. Okay. But it will be like little bit jargonish, right? In terms of ye kya hota hai, wo kya hota hai, and all that stuff, right? What we will do is, we'll quickly do say 30 questions in equity, and we will try to attempt say 5 to 10 questions in currency, today, and we'll go through more of that, in the coming days as well. In the currency, I wanted to actually quickly show you, right? How a couple of numbers gets played. Okay, but let's get started with this. I think these are very easy. You can crack this, right? Yeah, the first one is B. I'll quickly revise the concepts as well, as we go along. Okay. Initiation of future contract, pricing of underlying asset has risen. What happens? The stock has gone up primarily, the long position becomes profitable. It's as simple as that, right? One. Okay. Okay. This one. So most of the numericals, you can keep calculating while I talk. Most of the numericals in equity derivatives will be as simple as this. But I want you to focus mostly on whether they are asking for short or long. Okay. In this case, he just directly asked about the profit or loss, which means, what is going to happen? 768 को खरीदा है, 778 को बेचा है, right? 10 rupees profit मिला है, 1200 times 10 is 12,000 rupees profit. Okay, A. Okay, it's as simple as that. But sometimes what happens is, he will ask you, I have gone long, I have gone short. What is going to happen? Please mind those, what I mean to say, the wordings, very carefully. Okay. I hope all of you got it done. Okay. Trading is allowed in Indian equity markets in which of the following? Quickly. Quickly, should not take much of the time. We have done enough. Yes, D. All of the above. Okay. Next. Okay, this is very important. This is exactly what we spoke about on the fundamentals. And the main difference between forwards and futures, right? On day one. What is the answer? Yes. Can anyone sell the futures even if it does not own any such assets? Absolutely yes. Right? Because what did we say? The Goldsmith example, go back to that. What did we say? Futures is just a contract. I'm neither owning it nor paying the price. It is just a contract. So the answer is yes. Okay. Margin कैसे आया sir? Okay. This is very interesting question again, very famous. We discussed about calendar spreads. This is exactly what I'm saying, right? It will exactly come from whatever the topics that we have discussed. Now attempt this. This is very easy. Calendar spread 3 months. How many? Very good. Very good. Very good. Awesome. Awesome. Arey yaar, must. You all will crack. Very soon. 3, the answer is C, because first month to second month to third month, and first month to third month. Okay, it's a simple, what I'm going to say, the permutation and combination that we studied in our math classes, in our school days. Okay, very good, nice, lovely. Okay, this is also very easy. Futures contract and the price rises. What happens? You're able to get it right. Most of the questions will be like this only. Yeah, A, make profit. Okay. Now, Kavita wants to sell on a futures market. For this, again, see, look into question number 5 and question number 7, right? What is the answer here? Exactly. Need not own the underline. Futures में आपको कुछ भी नहीं own करना है, right? You need not own anything, right? So that, like, you see here, right? Little, he has asked like a true or false question here. Here it is like, as if, right, some complicated stuff, they put it in the wording. Okay. So the concept remains the same. Quick. Nice. Very nice. Okay. I think we discussed this yesterday. Calendar spread in index futures will be treated as a 4-month contract if the near month contract is expired. What does it become? Naked position, right? 1 month, second month contract है मेरे पास, पहला month का contract expire हो गया, first month contract has got expired. What happens? I will be left with only one position, which will become a naked position for me. Okay, very, very interesting question, and I think NISM loves this question. Okay, nice. Quickly. Okay, we will cover this later stage. Don't worry about this part. Okay. Is it common to have derivatives contract without any expiration date? True or false? False. Right. Every contract should have an expiration date. Nice. How can you close a short position in the futures market? Not A. I think people are getting confused. Let me explain this here. See, here we are talking about futures market. The answer. Okay. See, when you are in doubt, right? Eliminate the wrong answers to start with, right? What is happening? First of all, the first option is talking about option, right? Futures and options alag hai, right? Both are different. So remove that. Okay. Now, how can you close a short position? What is second one saying? By entering into a suitable forward contract. What are we talking about? What are we talking about? Here we are talking about futures. There he is talking about forward, right? There is no point, first of all, there is no sense at all for us to talk about forward contracts, right? Okay, remove that option. Now let's go to D. What is he saying? Executing the sale of the same day. अरे हमको short position close करना है, हम क्यों short करते हैं, right? We don't short, So remove D. Answer is what? C. Executing the purchase of the same contract. Always say if it is a long position, you close it by taking a short position. If it is a short position, you take it by closing it by taking the long position. Okay, you got it right. In case if you are confused, don't worry at all. Okay, in the exam, just try to eliminate the questions. Most of the times, the questions are very easy. They are like sometimes the options are not at all even relevant at all, right? Because first one is future say option A, no relevance. We are talking about futures, he's talking about forward, no relevance. And we're talking about short, he's talking about short, again, no relevance. Even if you don't do anything, your answer will be C. Got it, guys? Just trying to say how, even if you don't know, right, you can sort of attempt that. Okay, quickly. I think this is a very easy one. Yeah, I wanted to attempt this, because again, same concept that we discussed, but they feel that it is sort of little tricky, No, I don't want you to get it wrong. Yeah. क्यों B क्यों डाला sir? Okay, let's repeat it. No, sir, Arun sir, why are you getting B? Okay, what did we say? First, what is there talking? Forward contract specification and future contract specification, right? For what is forward contract? Forward contract में हमको बहुत सारा flexibility है ना, right? Go back to the Goldsmith example, right? I need not honor, he need not honor. But whereas in futures contract, what happens? It's a standardized trading mechanism. Everything has to be done. There is a settlement, there is a margin, there is everything there, right? So there is a higher flexibility in fixing forward contract. Yes, the answer is yes, actually true. You're getting it right. Same concept that we discussed, right? वो घुमाता है वहां पे, but you just need to read through the words. That's it. Perfect. Now you got it right. Now the exam is very easy. It is just that you have to be little patient and read the answer. Don't jump. Okay. Okay. Index futures and open position can be settled by using. We studied this. Very good. Nice. Why people are getting confused? Yes, B. Same thing, right? What did we say? If we ever get any question on the futures, always go back to our Goldsmith thing, right? What did we say? मेरे को खरीदना है gold, right? I have to close the position in 1 month. What will I do? I will pay the cash and I will actually take the position. That's it. Cash settlement of maturity. All of you got it correct. Nice. Okay. Future prices are usually more transparent than forward prices. Yes or no? You see the same concept, how they ask these questions, repeated. Yeah, absolutely true. Wonderful. Okay, near month we studied this. Yes, got it. Perfect. Okay, we studied this one, basis. Very good. Basis is the difference between spot minus futures. Spot is the cash price and futures is the futures price. Okay, it's very simple. Okay, we do face this every day. Tell me this. B. The answer is yes. It has actually become expensive because of higher margins. Okay. Now, this very interesting question. What is the risk of a bad delivery in an index futures contract? What is the risk? Very good. Lovely. Arey yaar. You will all do with flying colors. We'll do this. I'm loving this. Made our Friday
Kiran,
evening.
can you please, Kiran, can you please just explain this answer basically?
Sorry?
Can you please explain the
One
why
second,
the
one second. Yeah, Bollier, tell me, sir.
I'm saying, can you please explain why the bad deliveries does not exist?
Why doesn't it exist? Tell me. That is exactly what we studied. No, forwards में क्या होता है? Forwards में I can back off. The goldsmith can back off. To remove that and to bring the standardization transparencies where the futures have come into the picture, right? Why does there is no bad delivery? Because there is an exchange, there is a settlement mechanism. These parties are ensuring that there is what is a bad delivery. Say, for example, if I'm buying Reliance, right? I'm not paying and honoring the contract. Will I be able to do so in the Indian market? I can't, right? Why? The broker will ensure that I pay. And the settlement mechanism, the clearing, settlement mechanism will ensure that in case if I am, selling it in losses or if I am selling it in profits, they will settle it, right? That is the whole mechanism. So it's the same concept, sir. Standardization, usko ek kya kiya, question mein lagaya, bas, that's it.
Sir, it is like an ambiguity question, sir.
No. It's just that, what is ambiguity in this?
Because everyone is saying by forward you are always going to make money, so it is not the same case. So that's the ambiguity.
No, there is no ambiguity. So he's testing you. What are the characteristics of a futures contract? That's it. There is no ambiguity at all.
With reference to futures only, we have to get it context. Okay, okay.
Yes. Okay, I think we did. Someone mentioned yesterday. I think for this question, guys, let's stick to last Thursday of every month only. Let's not challenge this NSM, guys. I think let's stick to last Thursday only. They have changed this, but I think their options did not change. Okay, 21 quickly. Okay, if it is Tuesday, see, if it has given Tuesday and if your option is Tuesday, put Tuesday. But in case if if the option doesn't read Tuesday, then you have to choose Thursday. Okay? 21B. Yes, yeah, correct. Got it. Everyone got it. Okay. Quickly, we'll do two more questions. Here. Okay. Okay. I wanted to quickly attempt this, guys. Quick math. Quick math. 3500 पे शॉर्ट किया था, 3410 पे बाय किया था. What is that difference? 90 times how many profit? How many lots? 10. And what is the index? 50. 90 times 10 times 50, 45,000. Got it? Not 9,000, sir. 90 times 100 lots times, one index lot is how much? 50. You have to multiply that with 50 as well. Okay. In the numericals, as I mentioned, right? See, I think I don't know how many NSA exams I have given, right? I have MFD, PMS, research analyst, fund manager exam, SIF exam, everything. Okay. I'm telling you, compared to research analyst exam or an investment advisor exam, the numericals here are very, very easy. Just be careful on the the only thing that you have to be little cautious here is there is sometimes A times B times C. Don't miss on that C part. Okay, just be little cautious and double check. Otherwise, it's very simple, straightforward ones. Okay. Quickly. Okay. Let's do one thing. It's 8:58. We'll do one more here. Yeah, might we attempt this 23? Because I wanted to give a flavor of what happens. I mean, you all have done the MFD and other exams as well, right? So they will give you all the statements, and most of the times, when it is all of the above, it will be all of the above 95% of the times. Okay, but just double check. That's it. You got it. Everyone got it. Very nice. Okay, this one. Read through this little cautiously. We discuss calendar spread. Read through this little cautiously. Yes, got it. Perfect. Bingo, bingo. Lovely. Nice. It's two different delivery months, but we have to, work under the same underlying asset. Okay. I think yesterday in WhatsApp, I gave you the example of Reliance and what happens when, our hero says something, right? Okay. No, sir. Nimesh, sir, it's not like, two different underlying assets. It has to be one asset only by them. Okay. Okay, cool, perfect. Let's switch gears, and I think you guys are already an expert and pro in equities now. Let me quickly go through. I'll share this for you to practice over the weekend. Don't worry. Okay. 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 I think this is the concept that we studied, an hour ago. Please attempt this. And tell me. Anyone got the answer? Good. Nice. 147 times 1 plus 7% is 0.07 divided by 1 plus 10%, which is 0.1. Okay, so that is going to be our answer. Everyone got it? 47 times 1 plus what is 7%, 0.07 divided by 1 plus 0.01. Okay, clear everyone? We have discussed about the interest parity principle at the start of the session. Okay, cool. Let's quickly go through. Okay. I think I might have discussed or I might not have discussed that. Please be cognizant of this. The final settlement will always happen on T plus 2, not T plus 1, T plus 2. Okay. This we will study, when we study options. But if you want to attempt, you can attempt this. These are very famous questions. We will go through this multiple times. We will do lots and lots of this. Because this is where the currency derivatives might become. I mean, people feel that the exam is little tricky just because of these sort of questions, but it is not. Okay, don't worry about that. We'll do that. Don't worry, guys. Okay, I wanted to attempt this. Outstanding contracts in the future market at any point of time is called. No. Read. Yes. Open interest, not open position. Guys, it's OI. Okay. Remember that OI, right? Now number of outstanding contracts, at any point of time is open interest, not open position. Okay. Just be little cautious there. Okay. Nice. Very good. We'll do that later. Okay. I think this is similar to the equity thing. Attempt this question. Attempt this question. Same simple, like similar to equity. I want you to read this and then attempt this question. It's very easy. What is happening here? C, Tycho, no. D, very good, lovely. You all got it. Simple, what is happening? he is actually taking a long position, but what has actually happened? Instead of the price going up, the price came down to 71.70. That means he made a loss. How much is the loss? 72 minus 71.70, which is 0.3. Now, what we need to do, we have to multiply 0.3 with the number of lots, 30. 0.3 times 30 is 9. 9 times lot size is 9,000. Okay. So, he makes a loss of 9,000. Got it, guys? The answer is D. 0.3 times 30,000. 0.3, sir. Okay. Most of you got it correct, which is nice. Perfect. This is a very famous question. If you want to attempt, let's attempt this. Actually, attempt this, guys. Try to attempt this, and I will explain it to you. This is in parallel with the open interest concept. Try attempt that. I'll explain it. Actually, let me sorry. Yeah. Anyone was able to crack it? Oh God, lovely, nice. B is the right answer. I'll quickly explain this and we'll close the session. What is happening here is see here. What is he asking primarily? There are 3 components here, right? A trading member has 2 clients, X and Y. On one day, the trading member buys 20 lots of 1 month futures and sells 2 lots of the same contract. Okay. So what will be the open position there? 20 minus 2, 18,000 to start with. Okay. Then the client actually buys 12 lots and sells 2 lots. Okay. So what is the open position? 12 minus 2, 10. Okay. Again, Y buys 12 lots and sells 2 lots. 12 minus 2 is 10. Okay. But now having said that, what is the lot size here? We need to multiply with 1,000. Okay. Now, what happens is a trading member, please listen to this. This is a very favorite question which comes, client positions will remain the same. Okay. X has how much? Right, 12 minus 2, 10. 10 times 1,000, 10,000. Y position remains the same, 10,000 and 10,000. But whereas, the trading member position will be equals to, please listen to this. The trading member position plus the client position, how many clients are there? Those client positions also combined. Okay. In this case, the trading member position will become 18,000, in this case, because he has sold 20 minus 2, 18,000 plus 10,000 plus 10,000. Okay. Total 38,000, 10,000, 10,000. Okay. So that is going to be your answer. Got it? We will do more of this. Don't worry. But for now, the trading member, if he is doing it, it is a combination of his, what I mean to say, positioning plus the positioning of the clients as well. Okay. Just remember that. Okay, cool.
How come 38,000, Kiran?
Sorry?
How come it has come 38,000? Because 20 minus 2 is equal to 18. Then it should be 18,000.
That's what I'm telling you, sir. 18,000 plus what is the X position?
10,000 more.
Plus what is Y position?
Okay, it merged all together.
So the answer is B.
Yes.
So 38,000 plus 10,000 plus 10,000.
No. Trading member का पोजीशन कितना है 18,000, X का पोजीशन कितना है 10,000, Y का पोजीशन कितना है 10,000. X position is 10, Y position is 10. Trading member position will become 18 plus 10 plus 10.
30, they got it. But again 10 why? Only 138 is including of 10, right?
What is the question, sir? Read the question. Question is, what would be the open position of the trading member, client X and client Y respectively?
Okay.
A
got it.
10,000 client X का है, a 10,000 client Y का है. This is for trading member. Got it?
Yeah, got it.
Yeah.
Thank you, sir.
Perfect. Awesome, guys. Really loved it. I think I love that N2. You all will crack it, man.
किरण जी जस्ट एक क्वेश्चन में मुझे बार बार कंफ्यूजन होता है। मैंने एक बार ट्रेनिंग पहले वो इंटरेस्ट रेट वाला ना, इंडिया में इंटरेस्ट रेट पैरिटी वाला, इंडिया और यूएस वाला, बस वो मैं 2-3 बार एक्चुअली कर चुका हूँ पहले भी, फिर भी कंफ्यूजन रहता है।
Okay, can I tell you a very blind thing? If whatever is given, right, you pick up that number, times you do like, whatever is the first number that is given, 1 plus that divided by what is the second number, divide 1 plus that, that's it. It's as simple as that. Don't worry, we will do more examples of that, sir. It's very simple actually. Okay, any further questions, guys?
Yeah, last, not related to today's